I'm going to talk about the International Monetary Fund's outlook for Asia and ASEAN specifically. And let me start off by giving the key messages here. And this is really a big picture. We think the short-term outlook for Asia continues to be very strong, very robust. This also applies to Southeast Asia and ASEAN. And this is very much in line with expectations that we had at the beginning of the year. However, and this will be a focus of my talk, we think that there are considerable uncertainties to this baseline outlook. And what that means for the region, given this circumstance of relatively robust growth, good conditions, but big uncertainties, is that the region, of course, should prepare for this volatile time ahead. And our managing director, Christine Lagarde, put it, I think, very nicely and very catchy. She said that when the sun is shining, it's a good time to fix the roof. So with this, let me move right into the outlook. And I'm showing a lot of numbers here, but let's not focus on these numbers too much at this point. Really, the key takeaways here are, first of all, that Asia remains the world's fastest growing region. And I think what is really remarkable, and we've heard that in remarks this morning, how much Asia is really contributing to global growth. So last year, Asia as a region contributed about 62% of worldwide growth. China alone contributed 1/3 of global growth. So as Lord Desai said in his remarks, Asia is really where the action is in terms of economic growth, and it's the locomotive for the world. Let me move right along to the picture on inflation, because we've heard this morning about monetary policy. And Asia and Southeast Asia here is no exception from the other countries in the world. Inflation in Asia has been increasing slightly in the recent years, but it is still very subdued. When we focus on the big countries in Southeast Asia, the Philippines, Indonesia, Malaysia, Singapore, and Thailand, you can see here the black line. This is the Philippines. This is the only country where we have inflation above the central bank's target in Southeast Asia at the moment. Before moving to the uncertainties, I would like to make a remark on the external sector, because as you all know, this region is very open. When you look at trade to GDP, it's very high in Asia and Southeast Asia. And there's a great dependence on an open world trading system. This chart, again, for the 5 big economies in Southeast Asia, shows you the growth in exports. And you can see here this bump in 2017. This is when global trade growth picked up again after a weak period. And you see very strong growth rates across the region. A big part of the story here were electronics, where there's a very integrated supply chain within Asia, and the big Southeast Asian economies are part of this supply chain. Now, I included this chart in the outlook because I think one thing to pay attention to going forward is the slowdown you see on the external side. And this is not just showing up in the export data for Southeast Asia. We also see that, for example, in high-frequency indicators in North Asia. Korea, which tends to be a bellwether for electronics exports, we see some weakness. Also, Chinese survey data points to some weakness on the external side, or weaker growth on the external side. Now, overhanging all of this is, of course, the issue of trade tensions, and how that plays out for the region is very important. And perhaps we already see in the data some manifestation of these tensions through the sentiment channels. Let me, after this very short overview of the outlook, let me now move to uncertainties. And I'll spend more time in this talk on uncertainties because the baseline in the short term is good, but there are clouds on the horizon we are watching very closely. And the uncertainties are monetary policy normalization. We heard about this in the morning. It's the issue of trade. And the third issue I'm going to talk about are the spillovers from US tax reform. On monetary policy, I'm showing you here a picture of the federal funds interest rate going back all the way to the 1950s. And what we've done in this picture is we've added crisis episodes. These are the red lines. So for example, in 1997, you have here the Asian financial crisis. And what you can see is that what has happened in the past is that when there was an increase in US interest rates, there have been crisis episodes around the world. Now, I'm not suggesting any causation here. There might be other reasons. Monetary policy is, of course, tightened after episodes of relatively good economic conditions and easy economic conditions. So there might be something else at play. It might not be causation. However, I included this chart because I think history at least tells us that we should be alert in the current cycle of monetary tightening in the US to what that means for countries in the region. One issue we look at closely is leverage. And our Global Financial Stability Report, the flagship publication we have at the IMF on financial stability matters, last year included a look at leverage in sovereigns, the household sectors, and corporates worldwide. And what we show in that report is an increase in leverage pretty much in all countries in the world and in all sectors since the global financial crisis. The pictures I'm showing you here are corporate leverage on the left side and household leverage. And the bars in red are countries in Asia. And there are two things you can see on these charts. First of all, in many Asian countries, leverage is relatively elevated, both in the household and the corporate sector. And leverage has increased over the last 10 years since the global financial crisis. So what that means is that as interest rates rise in the US dollar space, and also in local markets, as perhaps central banks have to react to rising interest rates in the US, that there is a potential for financial distress in certain pockets and sectors. The second issue as it relates to the risks from normalization in monetary policy to Asia are capital flows. And we have seen over the last decade since the GFC, very large capital inflows into bond markets and equity markets across emerging markets. The picture here shows you the stock of portfolio liabilities. And you can see the high bars, this is Asia. So the stock is relatively high, and there has been quite an increase in the last decade. Now again, in our capital markets department for our Global Financial Stability Report, we did some technical work trying to disentangle the effects that have been driving portfolio flows into bond and equity markets in the last decade. And what we find in this work is that a big driver of these capital flows have been easy or accommodative monetary policy in the US and quantitative easing. So this suggests that now that we are going into reverse with these policies, there could be a reversal of capital flows from emerging markets and from Asia. But let me say very clearly that our assessment for Asia is that these risks are manageable. And why I'm saying that is, it's because policymakers in the region have built buffers. And what I mean with policy buffers are prudent fiscal policies. It's also building foreign exchange reserves. So when we, for example, compare the current juncture with the time of the taper tantrum, when we saw a rise in US interest rates leading to stress in emerging markets, these buffers seem to be much stronger in Southeast Asia this time around. Since this is something that happened very recently, the stress episode in emerging markets in May and June I've included a few slides because I think it's instructive to think about the kind of volatility episodes that we are likely to see in the year or years ahead as the Fed keeps raising interest rates. And as you are all well aware, in the stress episode, the Southeast Asian countries were also affected. The chart I'm showing here are portfolio flows in bonds and equity markets. And you can clearly see that in May, June, there were large outflows from the region. These are the big economies. And in fact, looking at the entire second quarter, these are among the biggest outflows from the region since the global financial crisis. This has translated into price action in markets. Equity markets are back where they started in 2017. Most of the gains have been erased in the region. Bond yields have increased in most economies, both in the sovereign and the corporate space. And exchange rates that you can see on the left side have depreciated since April across the region. Now this leads me then to the policy response that has taken place to this turbulent time. And exchange rate flexibility is a very important part of this. At the IMF, we usually say to countries that exchange rate flexibility should be the shock absorber for external shocks, and it should be the first line of defense. And you can clearly see that countries have reacted to these pressures in recent months in this way. There have been two more elements to the policy response. These elements have been foreign exchange intervention. This is especially the case for Indonesia, but also Malaysia intervened actively in the foreign exchange market. Finally, it has led to changes in monetary policy. Indonesia here notably has raised interest rates by 100 basis points. But let me say, we think this episode illustrates that the region has strong buffers. When you look at other regions, of course, Latin America, stresses seem to be much stronger during this episode. Argentina has entered into a program with the IMF. Also in parts of Europe and EMEA, stresses seem to be larger in this episode than in Southeast Asia. Let me move to the second uncertainty that we closely watch when we think about the outlook. And that's, of course, trade. And I'm not going to rehash the discussion on this, just to say, of course, the big one that we are closely watching right now is the so-called Section 301 investigation. This is the US looking into unfair trade practices for technology and intellectual property. And we had 34 billion of tariffs on both sides coming already into effect last week on July 6th. Another 16 billion of tariffs are likely to come into effect in August. And then, of course, yesterday, the announcement that the US trade representative is looking into another 200 billion of tariffs on China. To put that number into perspective, total imports of China from the United States are 130 billion last year. And this is not just, of course, about China. It's really about the region. The region is very, as I mentioned earlier, is very open to trade. It is very integrated through supply chains. And there are many linkages between China and the other Asian countries through this supply chain. And a way to show this is this pie chart here, which shows you of the total exports that China has to the United States, what is the portion of value that is actually created outside of China? So think of an iPhone, the components coming from other countries in the region. And this number is about 31%. So clearly, even if tariffs are limited to China and the United States, this will disrupt supply chains in the region, and the ripple effects will be negative for the region. Since the news flow on trade is really day by day, what we've done is more a general thought experiment using our big macro models to see what would be the impact of higher import costs. And the way we do this in these charts is we simulate a 10% increase in import costs over 3 years. And I don't want to focus on the numbers itself, but the key takeaway is that any of these big macro models clearly show that this is negative for global GDP growth, it's negative for global investment, and it's, of course, negative for trade. And these are the direct effects that are itself hard to model, but perhaps more worrisome and even more damaging could be the indirect effects of trade tensions. And what I'm thinking here is, of course, the impact on business sentiment. You might see reduced investment, consumer confidence, how financial markets react to that. And the chart on the right I just included to show you the immediate reaction to the announcement of auto tariffs by President Trump. You can see immediately the reaction and the sell-off in European and Asian automakers after this announcement came back in June. So with this, lots of uncertainty on trade. It's a big issue for the region. It's a big risk that we are closely watching in our outlook. The final issue is that we have lots of uncertainties about is tax reform in the United States. And the key elements of this tax reforms are reduction in the corporate income tax from 35% to 21%. The second important part is the immediate expensing of investment expenses, and of course the shift from a worldwide to a territorial taxation system. And there are manifold spillover channels. Let me briefly talk about 3 of these. First of all, our US team thinks that the tax reform will boost growth in the short term. The number we have there is a boost to growth cumulatively over the next 3 years, 2 years growth of 1.2%. And simply by greater US demand, greater demand for imports, this is positive for Asian growth. The second effect that we look at is tax competition. The US has lower tax rates, and that, of course, might lead to some diversion of investment, perhaps to the United States. And the last issue that is discussed in parts of the financial markets is the impact of the repatriation of profits that US corporates, for tax reasons, have parked outside of the United States. And the question is, what does that mean for the availability of especially US dollar liquidity outside of the United States? We have done a modeling exercise taking this 1.2% increase in US growth over the next 3 years and looked at what this does to Asia. And what you can see here is that the average impact for Asia is about 0.2% of GDP additional growth over the next 3 years. So it's a positive impact, but it's relatively small. Now, there is some differentiation across countries. We think that the effect on Cambodia, Vietnam, for example, will be larger. And this is a function of these countries being relatively open and exporting quite a bit to the United States. But let me say also that, and this relates to what Jack Lew said about this tax reform, it's coming at the peak of the cycle. The employment is very low in the United States. The Fed is hiking interest rates. So our US team thinks that actually the long-term effect of this tax reform on the level of GDP is 0. And if the long-term effect for the US is 0, we would think that the long-term effect for Asia is probably also 0. Finally, I mentioned that there might be an issue with tax competition that could affect some of the countries in the region. And the chart on the left shows you that the US, with its 35% corporate income tax rate, was really at the high end compared to most Asian economies. And now the US is more in the middle of the pack. Now, a caveat here, of course, these are statutory rates, and effective rates tend to be lower, especially in this region. There are plenty of tax incentives given for corporations. So the comparison is a little bit difficult to do. Finally, the issue of repatriation. The chart on the right shows you the foreign pre-tax income reported by US multinational corporations across Asia. And you can see that a lot of profits are booked in Singapore. However, on this issue, I'd like to emphasize that so far, we don't really see much impact on Asia. Repatriation seems to have started when we look at corporate reporting, but we don't see, for example, a particular tightness in US dollar funding in this region. Now, part of the reason why that might be the case is that actually the amount of profits booked in Europe versus Asia is much larger. So these are the three uncertainties to the generally benign outlook that we see. Let me very briefly touch on some of the big long-term challenges that Asia faces. And I need to wrap up so you get to lunch. But let me say demographics is something we, for the long term, watch very closely. Two key takeaways here. Asia is actually aging very fast. When you look at the pure speed of aging, Asia is aging faster than Europe. And also Asia is aging at a very low per capita income level. So China's working age population peaked back in 2011. And this was at about 20% of US per capita income. And why does that matter? Well, it's much harder to grow and to grow fast when you have unfavorable demographics and an aged society. With this, I would like to thank you very much for your attention. And I'm not going to talk about policies because the bottom line is really times are good for Asia, and this is a time to build buffers for the volatility ahead. Thank you very much.